Hello everybody and welcome. We're just about ready to start. Let's do a quick sound check, make sure that everybody can hear me all right. So if you could please type yes in the question box, that'd be great. Well, that's nice. Hello to you too. That's fantastic. Great. All right, so let us start. So hello everybody and welcome to Nadex webinar series. We're going to look today at trading the S&P 500 and other equity indexes on Nadex. My name is Tamar Mer. I'm part of the trading team at Trade with Precision. Now, as we go through this presentation, and index market has been very hot topic in the last couple of weeks. So if there's any questions that you want to ask or any things that is unclear, please just type them in the question box and I'll pick them up as we go. But before we start, we need to go through some risk warning as disclaimers. So please have a read through them. Make sure that you agree with them before continuing on to the presentation. So they're going to be two, one for Trade with Precision and one for Nadex. I'm going to give you a couple of seconds to read each of those. And the second one. All right, so I want to tell you a little bit about Nadex and about Trade with Precision. Well, Nadex is a derivative exchange that is subject to regulatory oversight by the CFTC, and it started in 2004 and has been operating in this structure since 2009. It is based in Chicago, which is the financial heart of futures and options market. They've got all contracts that are settled in cash. There is no physical delivery, so you don't need to worry about expirations of future contracts. And you've got a wide range of global markets to trade with two very unique vehicles, and that would be the binary options and the spreads. A bit about Trade with Precision. Well, it was founded by our head trader Nick McDonald's in 2006 to provide education for retail traders. We also provide international trader training for clients of global brands, and that include exchange and brokers worldwide. We team up with Nadex in 2011, and we are a company that runs by traders for traders, and we specialize in trading strategies that are applicable to any market and any time frame. We're going to start to see today a bit about these strategies and the indicators, the information, the layers that we are looking at for building up a trading opportunity. Now with Nadex, you can also trade on the go on all of your devices, and this is fantastic. So you can filter for trading opportunities by searching the binaries price from 0 to 100. You can get a fast and secure, flexible access to binary options and spread, and most of the popular market will be available in real time. You can customize your chart, add the multiple time frame and indicators, and you can look at your open position, your working orders, and your account balance. All right, so what are we going to see on the agenda for tonight? So first of all, we're going to have a basic look at the equity index. For some of you, it will be just a repetition. Some of you know that, but it's good to bring the newbies up to the same level so we all understand what it is that we're talking about when we're talking about an index future. Then we're going to look at the benefits of trading index futures, and this topic is quite interesting, especially today when we're talking about support and resistance level, because if you look at the chart currently, they're all sitting at their massive levels of support and resistance. We had a rejection candle yesterday of this level, and it's going to be a very interesting time to see whether the market looks to break this level or it's going to bounce off it. So we're going to look at a couple of things that we are doing, that we are looking to assess where the market have a higher likelihood of going next, and on top of that, build up our trading opportunity. So we're going to see examples of support and resistance trade that are, it's a screenshot, it's not going to be a live example, but you can take that idea and look at the current market where it sits right now and try to look for those levels of support and resistance. And also we're going to look at example of how to trade the S&P 500 with binaries and with spreads. We're going to see a bit more about the differences between the binaries and the spreads. There are other webinars that we run that are dedicated to the binaries and the spread if you want to understand more about them. And also we're going to talk about trading the Nasdaq with Nadex contracts. So we're going to give another example from a different index market, and also talk about how you can further your trading and your education with Nadex. So let us start with the basic. So what is an equity index? Where an equity index is really a cash index, and it's measuring a section of the market. Now, when we talk about a section of the market, we can look at things like by the company size, so the 30 biggest company or the 500 biggest company if we're looking at the S&P, or the Dow being the 30th largest company by market capitalization. But we also can look at something as similar industry, and that will be like the Nasdaq. So we are grouping companies together into a basket, so to speak, and we are looking at representation of this company in that index. So when we look at the S&P 500, what we're looking is basically the 500 biggest companies in the US, or rather market capitalized companies. And what we're looking at is in effect the benchmark for the US economy. So even though if you look at the Dow, if you look at the S&P, you know what, they move quite similarly, but there are some sort of differences. So in actual effects, if we look at the chart, just being the chart, what we're seeing is it's quite a similar move. The Nasdaq is a little bit different. It's going to be like minor differences as well, because when there's good economic outcomes or expectation, then we see all of the market going higher. Where there are doubt and fear, we'll see all of the markets going lower. But things that we see, such an example, if you think about the Nasdaq had a higher high on the monthly charts, where the S&P had a lower high. These sort of things makes a little bit different when you're looking to choose, if I am bullish, which market am I going to go with that, and if I am bearish, which market would I prefer to that. So we need to be aware of those little differences between them, but as an overall, they do tend to move quite similarly. So this is just as an example to the situation of what is going on right now. But if we come back to what is an index future, well, it's taking all that information, and it's used to be just for hedging. So think about it this way: as a pension fund, as a hedge fund, you would buy into the market, you would buy share in certain companies, and you want to protect yourself from correction or from market that suddenly have a sell-off. Because if you're only going as a pension fund and you're only going long, you're only buying into the market, what happens when the market is pulling back? You don't want to lose all of that profit or even going into the red. So hedge funds, pension funds, they started to hedge against it. They could sell the index and buy the share, and that will be a hedging position, because if the market is selling off, then the position on the selling of the index market on that future will make the money that can offset the losses on the share that they've bought. So that's how it's all started. But really now they are so heavily traded that sometimes they are leading the market more than the cash market itself. So you'll see there are a bit of differences as we go into different future dated contract. There will be differences as well in the pricing, depending on when the market is going, expecting the this index market to be in the coming few months. So what we are going to look at today is looking to capitalize on these movements in the index market. Now, this is highly traded, highly volatile market, which is exactly what we want as traders. As traders, we need the market to move, right? I mean, if there is no movement, and by the way, there is a way to trade when the market is going sideways as well, but you'll get a higher reward to risk when we have a moving market. So as traders, we want the market market to move. And that's what we're after when we're looking at high liquid market. We have more and more opportunities on these markets. So the index market in itself is appealing for fundamental traders just as much as for technical traders. So that all coming from the fundamental, from the technical, it all comes together, giving us a higher level of liquidity and volatility in this market. So when we're talking about the benefits of index market, we can also consider them to be a bit more fairer than just going into the stock market. Because if you go into a specific stock, then you are subject to, maybe there's some monkey business going on there in that company. Maybe there's some market maker manipulation. Maybe the board of director had not been that truthful with the market. There's all sorts of things that can happen when you're talking at one specific company. But when you're looking at a bunch of companies put together inside an index, it's a lot harder to manipulate the market. It's a lot harder to make the market move in that big shares size of a trade. So it is still, in a way, technically or theoretically could be possible if you had a huge sum of money and you would push the market in a certain direction, but it would be the fact that we have such a high liquidity in it, it's going to make it very, very hard to actually come about. So these huge levels of volume make the market harder to manipulate, which is really good for us as retail traders. And with volume come volatility and price movement, volatility, liquidity. These are all translating for us to trading opportunities. So another thing that I absolutely love about the index market is that no matter what time you have to trade, you will have an opportunity to look for a trading opportunity. I know it sounds funny, but when you think about it this way, when we only had the cash market open, then if you're working during the day, you don't have time to trade that market because the market is open while you're at work. You're coming back home in the evening, then you can't trade that market. Currently, this future market is open almost 24 hours. It's only closed for a short break for adjustment of prices and all. It's about 15 minutes, and then it reopens again. And that offers us an ample amount of trading opportunities all around through the day. It also allows you to trade other markets that are open. So, for example, now in the evening, you've got the Nikkei that is open. So if you want to look into a market that is currently open, you can look at somewhere else around the world. We get a bit more opportunities around that, and they tend to influence each other as well. So you'll see that if there's a movement that happened during the Asia session and then during the Euro session, say the DAX has been moving in the market, which is the German index, then you'll see the US market opening in a gap, and a lot of the time we'll get a nice move as the market open to close that gap. So it all gives us more and more trading opportunities depending on the strategies that we're looking to utilize, and also depending on the time frame that we are looking to trade as well. So you also have the binary options that you can trade really 24 hours a day. You can look at it as a binary option over a weekly time frame, but when we're looking at the spreads, we're only looking at the daily expiration. Another very, very interesting thing that happens with the equity market is you get to have really nice and beautiful flowing trends. So you can look at this example right here. You can see at the ES, which is the S&P, you look at it and you can see this is on the daily chart, beautiful uptrend, no extreme buying or extreme selling. It's just a nice flowing momentum that we've got here. And you can look at the same on the right hand side on the Nasdaq, and what you can see is on the 1 minute we also have a nice flowing trend to it. Now I will say this, when the market is closed, it's really hard to get this nice flowing beautiful 1 minute chart on the index market. You usually go on a higher time frame for that, but when you look when the underlying market is open, 1 minute chart, 2 minute chart, 5 minute chart will generate beautiful trends when we can look to trade during that day. And also, when you're thinking about what type of trader you are, this is something that I want to throw into the mix. Think about the time that you have to trade, because if you're looking to trade very, very small time frame intraday, it might be a little bit harder to do when the underlying market is closed. So if, for example, I'd like to trade the Nasdaq on the 1 minute, currently right now, I'm not going to have a beautifully flowing type of chart as I do right here. There's a question that came through. Let me just please finish this section and I'll go about and read the questions. So when we talk about cash index versus the index futures, so what we have here is we've got a list here of some popular markets that you'll find are tradable both by private, retail trader, professional traders all around the world. And you can have the Nadex binary index to them. So this is just really to understand the naming. There's just a naming convention really. So if we talk about the Dow Jones, then the future contract, the symbol for it will be the YM, and you can find it under Wall Street 30 on Nadex. The S&P 500 is the ES, and then you find it under US 500 and so forth. The Russell, by the way, really interesting index at the moment. So the quote for it is TF, and then you're looking at the US Small Cap 2000. So just kind of remember this name around as we're going through the presentation and as you're looking at the platform. Okay, let's talk about the benefits of binaries and spread. So one of the things that I think is the strong and most important thing that I can ever say is that you've got fixed risk, especially in markets that are so volatile and they can move so rapidly. What you'll find in the traditional way of trading, your stop might be slipped. So you say, for example, you want to have a stop at the level of 1080, but the market has broke down through that level so strongly, and that your stop out was about I don't know, 1082 or whatever. So you got about 2 points extra on your stop. That can't happen with Nadex contract. That there is a fixed risk, no matter what the market has done. If it closed against you 1 point or 500 points, your loss is still going to be the same. And I can't emphasize enough how important controlling the risk is when we're looking at trading. You can be the best trader in the world, but if you don't monitor and control your risk, your underlying overall account can be in the red. You don't need a lot of capital to trade this contract, and then you would, comparing to what you would need when you trade the underlying market. And it gives you different type of trading opportunities as well. You can look to make a one-to-one in a market that moves sideways, which is really hard to do on the traditional way of trading, because you need the market to move. Traditional way of trading, so basically buying the market and expecting it to go 50 points higher, my stop loss would be 50 points below. I need the market to move. Where with the Nadex contract, all I need to do is for the market to not do much or just stay where it is right now, and I can make approximately a one-to-one on that. So it adds more trading opportunity for us. And you can also create different reward to risk scenario. It doesn't have to be just a one-to-one or a 10-to-1, because we all know that if we're looking at a 10-to-1, our risk is increased, that we're not going to get there. So you can mix and match between these scenarios, so get a one-to-one quickly and then look to profit some more on your second positions and so forth. Okay, so let me pick up a couple of questions before we get into the next topic. This relates to the previous webinar you kindly conducted on the 3 advanced course. Okay, I have some questions that relate to trading using the recipe. May I please email you those questions? I deeply appreciate you helping me through those doubts. There is, so for those of you who don't know, we run an advanced course for Nadex as well. We're going to talk a bit more about that, where we teach our trading strategies. So this person has joined us on the previous one that was run, I guess, in December, and there's a few questions about that. You can, there's a contact form on the Trader with Precision website. I think that would be the easiest way to go about it. So perhaps that would help you there. Is recording will be available? Unfortunately not. I've got a comment here to 108. I wonder what that refers to. Please let me know if there's a question there. What indicators and settings do you use? We'll talk about that a bit more as we go into the presentation, but we do talk about the indicators, the setting, and the recipe, so the trading strategy itself, in more details on the advanced course. So obviously we don't have a lot of time today. I'll rush through things, but we'll do that in detail so we don't keep anything a secret here. Okay, let's continue. So levels of support and resistance. How do we locate levels of support and resistance? We're going to give an example on the S&P and on the Nasdaq, but really that is applicable. If you think about it, any market, S&P, index market, forex market, commodity market as well, they all will be applicable. And levels of support and resistance are extremely, extremely important vehicle or piece of information that we can take out of the chart, because trading around it against the direction, so thinking of going short just as the market touching a strong level of support and resistance, can really diminish the probability of that trading opportunity. So being able to identify it can really increase your probabilities of the opportunity going to target. Now, there is some misconception when we're talking about levels of support and resistance, and at Trade with Precision, we really don't think that sloping trend lines are levels of support and resistance, because it all depends on how you draw the lines, really. If you think about it, when you look at a chart, take any chart and you look at it on your mobile, right? So the screen is quite small, so the highs and lows that you connect, it's all depend on the information that you see. Then you come home and you're looking at your 33-inch computer screen, suddenly you have a lot more data. Suddenly you're connecting different highs and lows. What does it mean? Does it mean that the previous one was wrong? Does it mean that this one is right? Which one is correct? When you're on your own, just looking at two different devices, seeing different lines, seeing different levels, that means that there is some sort of ambiguity. There is not clear cut where the level sits. So if just one person doesn't have a clear cut where the level sits, what about the rest of the trading community? Because you know what interesting about trading, you really want to see what everybody else are seeing. You don't want to be the unique one that's buying when everybody else are selling. You want to see what everybody else are seeing and go with the flow of the rest of the market. So we need to be able to identify the levels that are what everybody else can see, that are so dead obvious that they are there in front of us. So what we are looking at, we're looking at a horizontal level. And what we define as true support or true resistance is when we have two or more touches, obviously within a couple of ticks or pips or points, at a certain level. So the level needs to be a flat level, and when we have a couple of touches in that level, then we can perceive it as a level of support and resistance. Now, I will say this, the higher the time frame we're looking at, the less precise in numbers that level is going to be. So if I'm looking at a level on the 15-minute chart, within 3 or 4 pips, that's okay. But if I'm looking at the level on the weekly, obviously it's going to be a lot more than 3 or 4 pips. It's going to be around the 20 or something like that. So it all depends as well how close is it on the time frame. So what we do, we really look at it visually. When you look at the chart, regardless of the time frame, can you actually draw a line between those levels and say, yep, this line is connecting, this horizontal line connecting all of those touches. So that's how we identify those levels of support and resistance. There are also reaction to these levels, because traders leave orders around these levels. So it will be an order to go against the trend, or it will be an order to close out of the position. Either way, is what it will do, it will cause a reaction as the market comes into that level. So if we know that as the market is coming into that level, there is a reaction, then it's sort of like a self-fulfilling prophecy, where everybody is seeing this, everybody expecting a reaction, so they're going to place an order in regard to that reaction, and then we have that reaction. So it's sort of like a level that keep on generating more and more reaction out of it. So we're looking at levels that have been retested in the past, and we're looking to have that happen again. Not every level that the market come to has no, it could break through it. It doesn't have to bounce from it. So there are other elements that we need to consider. What is the most likely scenario to happen? Is it going to break through it, or is it going to reject it and maybe the next time going to go ahead and break down through it. So this is the sort of technical ingredients on technical decision that we need to make around those levels, but we need to combine these technical ingredients together, because you know what, one reason is never enough. Just to say I've got a level of support and resistance here, therefore I'm going to trade it, it's not enough. Okay, what I need to do is to say, okay, I've got a level of support and resistance here, what else can I add into the mix to increase the probability of my opportunity going to target? So let me give you an example. So as we said, true resistance is when I've got 2 touches more at a specific upper level. So if you look at this one, what I've got here, and there is some confusion when I'm saying touches. So what I mean when I say touch is that when the market come up, traded higher, touched that level and fell from it, we have to have a reaction to it. We have to have a sell off that level. So this is the first time that we've done it. There's nothing in here to indicate anything else. Once we come up, touch that level again and fell from it, right now I've got a resistance level sitting right here up above. The more touches, by the way, on a level, the stronger the level will become. Similarly is a support, when we've got a touch and a bounce higher, coming down again, touching and bouncing higher. Now you can see that this one is not close enough. It doesn't matter what time frame I'm looking at. You can see that if I draw a line between this one and this one, it doesn't connect this touch over here. So this is very much visually type of identification of the levels, because you don't have to get cute and look with the numbers and see how what's the level here versus what's the level here. If the line doesn't connect or doesn't closely connect, it's not the level. And you can see over with this one, it went just a tiny bit below that one. That's okay. It's still within the same line, so we're happy with that touch as well. And you can see the reaction of the market to this level. Again, with support, the more touches we have, the stronger the level will become. Another golden rule of support and resistance level is when support is broken, it becomes resistance. And when resistance is broken, it becomes support. And this is a very, very nice way of trading, even if in a sideways market. And I wouldn't usually do that when I'm looking at traditional way of trading, but I'm very happy to do that when I'm trading on binaries contract. And I'll tell you why. When I look at this sort of scenario, so for example, I've got this level, I've got here resistance now turning into support. If I come up, say I'm in the traditional way of trading and I'm saying, okay, this is a very nice and strong level and I know this market is going to bounce higher from here. How high? I don't know. I mean, if it's going to come and test this support level and then fall from it, or is it going to continue higher? It doesn't matter, because currently my assessment is that the market is going to go higher. The problem with the traditional way of trading is you gotta have a stop loss. Okay, you can't just have an open trade. That would be completely risky and crazy. So if I say, okay, the market touched here, I want to buy. I got 2 questions right now. Where would be my stop loss? Where would be the right place to put my stop loss? Because remember, my one-to-one on my profit will also be dictated by my stop loss, right? If my stop loss is 20 pips, my one-to-one will also be 20 pips. So that's another question that comes through. And the second one is, I don't know if the market actually going to break through it, reject it, and then continue higher. Because if it does that scenario, I can get stopped out. I can get stopped out, and then this one will continue higher. If I do it over in a binary and I give it enough time, then I know that even if the market trade a little bit lower, I'm okay. I don't get stopped out. Yes, my contract currently is going to be in a red, but I still have a bit of time for this to work out, and then the market reverse, continue higher, and I can get my target. So I didn't add that extra risk of where do I put my stop loss, because you see, our stop loss, it's always dictated by a technically protected place. I don't have that in this scenario, so this is going to be really hard to do on a traditional form of trading, but really, really nice to implement when I'm using the binaries contract. So that is just one thing about looking at a sideways action, or looking about trades in between levels of support and resistance. Okay, So when we're talking about levels of support and resistance, one of the strategies that we are looking at is a breakout strategy, and that is where we expect a level to be broken. If we talked about support becoming resistance, resistance becoming support, we're really talking about levels that react and the market fall from those levels. But not always will the market fall from those levels. Sometimes the market will break through those levels. So when is the scenario that the market is actually going to go and break through the level rather than reject it once more? So one of the strategies that we're teaching is exactly that, how to identify a strong level of support and resistance that have a higher likelihood of breaking and continuing lower or higher if it was a resistance level. So one of the things that we need to see is the market pushing down into that level if we're talking about support? So is the market there's some condensed price action into that area, or the market depending on the candles, depending on what the market is doing, coming into that level, and also a couple of indicators that momentum indicators that will help us assess what is the next thing that's going to happen in the market in higher likelihood. We can see if this level is about to break, because you know what, when we've got a nice break of support and resistance level, there is a strong reaction to it, and then the market seems to be moving, and they're moving quite strongly. So being able to identify the differences between a bounce off a level versus higher likelihood that the market is going to break is a huge advantage for us. So you can see here in this example, I've got 4 touches in this level, and what also I've got, if you can see, it's a little bit hard to see, but I've got compressions of price, so the market is making lower highs over here. I'd like also that the market will come with smaller candle as it consolidates above that level before that break. So coming in with big candles mean that I've got wasted momentum. So looking at this scenario, if I get a red, this is currently a rejection candle, and I don't quite like it when there's a rejection candle off the level, but if the next one will be coming and looking red and small, it will be a really nice scenario for a break lower, and thus we take this support and resistance level in our favor as ahead of a break. So this is a bit about the levels of support and resistance. Now, as I said, it's not enough. We need to add more and more things to it. So one of the things that we would like to add is the trend analysis. Now, funny thing is that new traders, they look at trend analysis and they think it's just too easy, it's just too simple, it's too basic, therefore I don't need it. But on honesty, it really is the most important technical tools that we have as technical traders, because what it gives us is really the momentum in the market. It's if you think about it this way, if you take a dart or flip a coin, then you've got a 50-50 chance of being right. Is it a head or is it a tail? Is it going up or is it going down? But what do we want to do? We want to increase that probabilities, and if the market is already going lower, then where is the likelihood of the market to continue reverse and go higher, or continue to go lower with the momentum of the market? So you see, it gives us another push into the in one direction over the other. So we really need to be able to identify the trend, and there's a lot of information that we can obtain just from the price action alone. Combining this with support and resistance level can give us some really nice trading opportunities. Indicators, they're all like a secondary confirmation on the levels, on the strength of the trend and so forth. They are important. I wouldn't say that they're not, but they're not as important as the price action, because the price action will give you the better information about the price action. The indicators are calculation on price action, so there's so much that they can tell you in addition to what the price action is doing. So what we're looking to do is analyze who's in control of the market. Is it the bulls or is it the bears, or is it no one? Or is our tug of war ended up in the fact that no one has won this candle, no one has won this chart? This is a sideways market. Maybe I'll choose to take just a one-to-one on that one. Maybe I'll choose to walk away from that. So let's take a look. So an uptrend is simply defined by a clear series of higher highs and higher lows. Similarly, downtrend is defined by a clear series of lower highs and lower lows. And you see, the expectation is if the market just put in a lower high, such as in here, then my expectation is that the market is going to go ahead break this previous low and give me another lower low. It's a huge assumption in the market. It's a huge piece of information that I can get on this market, because if I can identify that this is the area when the market is going to put the next lower high, look at all the profit that I can look to make out of this move. A lot of the trading strategies, they say, okay, only when the market breaks the previous low, I've got a confirmation of a lower low, and therefore I can continue lower. But then what it gives me, it's just this tiny little move over here. What if I could identify this area as the next lower high? I have a much higher move for the market to make. So yes, there is a bit of risk in that as well. But if I can add more and more reasons to say this is the next lower high, then I have a high probability trading opportunity. And this is, by the way, what our second trading strategy is looking to do, is to identify the next lower high in the downtrend and next higher low in an uptrend, and look to capitalize on the move to the next higher high or to the next lower low. So this is an area of no trend, and basically it's anybody's guess where the market is going to go next. We don't know. We have, would it be a higher high? Would it be a lower low? I don't know. No one knows. And therefore, if I don't know, and if the market is not clear, then what does it does to my percentage success on that probability? It reduces it, right? So would I choose to go with a high probability opportunity or a so-so probability opportunity? It's really more than a guess when you've got no trend. So we're looking to increase our probability. So we usually tend to walk away from a no trending market, unless of course we're looking at a market that's stuck within a range, and then we can look to trade around those range. But it's still, there is some sort of information, technical information, that we can grasp out of that chart. Sorry, excuse me, I need a little bit of water. The next element that we found extremely important is multiple time frame confirmation. And this is something that a lot of traders tend to ignore. So think about it this way. Think about, you've got a 50-minute chart, and that 50-minute chart is currently in an uptrend. And that's fantastic. You're thinking, oh, I've got an uptrend, I've got a nice pullback, I'm looking to go long here. But what if that nice 50 minutes trend that is now forming as an uptrend, all that it is a pullback on the 4 hours trend, right? So the 4 hours is in a roaring downtrend, and from time to time that 4 hours need to pull back. So the market needs to trade higher to release some of that selling pressure. As the market is pulling back on the 4 hours, what happened to the 15 minutes? The 15 minutes change direction and turning into an uptrend. Is that uptrend have a long life ahead of it? Probably not. It's going to expire soon, because the 4 hours being the higher time frame is going to catch up with that release of that selling pressure and move on and continue into another selling movement. So you're going to cap your profit on the 15 minutes, and honestly, you're going to be finding yourself trading against the direction of the overall trend. So one of the things that we are looking to do to increase our probability is to look to see if we are trading in the same direction as the higher time frame. Think about it this way: it's like swimming with the current or swimming against the current. Obviously, it will give you a better push when you're swimming with the current. You're going with the waves, everything is pushing you in that direction, then going against it. And you might get a nice opportunity out of that 15 minutes, but you wouldn't get a high probability, high reward to risk out of that one. So we want to really limit the risk, or decrease the risk as much as we can, while being able to increase the profitability that we can get on each and every trade. Because think about it this way: we are putting the same risk on each trade. This is part of risk management, right? We're looking to put the same amount of risk each time. And our jobs as a trader is, it looks to see the best opportunity that also can generate us the best return. So when I'm looking at a trade that have agreement from the higher time frame, then there's a higher likelihood that I can get a further reward to risk out of that one. The higher time frame would also tell me a lot about the momentum in the market, and also can help me assess where to can I take this trade is, can I take it to a 1-to-1, 2-to-1, or maybe even a 5-to-1? Another thing that it's important to do to check the higher time frame is because levels of support and resistance can and will be more apparent on this higher time frame. So you can look to trade the market and you can say, oh yeah, we are definitely in a downtrend, we are definitely going lower. But then as you go into the higher time frame, you realize that we're sitting on a major level of support and resistance. Then what does it does to your trading opportunity? It makes a big difference. Entering just ahead of a support level can be something that, even though everything else tick the boxes on that opportunity, it can get your opportunity going to stop. So having agreement for more than one time frame add to the probabilities of your opportunity. So just as an example, we're looking at the ES here, and what we've got is the 60 minutes on the left and then the 4 hours on the right. And you can see that both of them are in a downtrend. So they're both in agreement, and this is really all that we're after. We're after for the next time frame up or the next time frame up to be in the same direction. If I'm looking, and this is something that I get questions quite a lot, if I'm looking at intraday trading, and I'm looking to enter of the 1 minute, 2 minutes, 5 minutes, and so forth, if it goes against the direction of the daily trend, I'm not that worried because it's such a higher time frame. I'm not too worried about that. I will always look at the daily because I would like to see the levels of support and resistance, but I'm very happy to trade either way on an intraday trading. However, if I'm looking at a 4 hours type of trade, I'll be very concerned with the daily. I'd like the daily to be in agreement with my direction. So looking at the different time frame, it really is matter which time frame you're looking at to trade. If you're looking at the 60 minutes, it is very much advisable to check the daily always, but even if it's against the direction of the daily, it might be borderline. But 4 hours, 2 hours and above, definitely to be in the same direction. It just depends on the distance that you're looking to travel. It's also dictated by the time frame as well. Another thing that we are looking at, and this is to answer into your indicators. So basically all that we're using are MACD and RSI, and we're using also the moving averages, exponentials or simple. They're all the same to us. More information about them on the advanced course, but what we're doing with this indicators, divergence and convergence, we're looking to see the momentum out of the price action. Okay, so we're not looking at them for reason to enter into the market. We're looking at them to tell us does the market has much strength in it to continue higher or to continue lower, basically to continue with the overall direction. Because remember, what we're looking to do when we're talking about the trend flow strategy as an example is to identify the next higher low or the next lower high in the market, so we can go and trade it to the next lower low or to the next higher high. So I want to see that there is momentum in that market, and that's why I'm using the momentum indicators, and I'm using just the standard box setting. There's no messing around with those. It really doesn't matter. What we're looking to see is that these indicators are flowing in the same direction as the market. So what I mean by that, if the market is making higher high, then I'd like the indicators to also make a higher high. If the markets are making lower lows, I'd like the indicators to also make a lower low. Now, if the market is making higher highs and the indicator making lower highs, what I've got there is divergence. What divergence tell me in a nutshell is that this market is running out of momentum. It doesn't say that this market is going to move from an uptrend to a downtrend for sure, and it doesn't say that it's going to happen right now, but what it does say is that we're running out of momentum, and I might not get my target. I might just be there sitting in a sideways action before the market gets again a bit of power underneath it and move higher yet again. Or it could be that the market is going to completely change direction and move into a downtrend. It gives me a warning sign. That's what it is. If I just got a little bit of a warning sign, but everything else tick the boxes, I might be okay with it. But if I've got a warning sign on this one, and then a warning sign on the higher time frame, and then the daily seems to be not doing that well, it becomes a lot of red lights in my way in that opportunity, and I would say, okay, I actually don't want to take that. So just as we are looking for as many reasons as possible to enter into an opportunity, we don't want to see many reasons not to enter into an opportunity. So it goes both ways. A question, what moving averages, 8 or 20? So we're using the 10, 20, 50, and 200. So we're using the 10 and the 20 to be the short-term moving averages, 50 to be the medium, and 200 to be the long-term. And honestly, when I use intraday trading, so lower time frame, I don't use the 200 moving averages. I find that it's a little bit, it's too long for an intraday. But the way we use the moving averages is a little bit different. We don't use them as price touch the moving averages or moving averages have crossed over. We use them as a zone. I don't think that we'll get to explain all of that on this session, but we definitely do explain that on the advanced course. So I'll tell you more about that course at the end of this session. All right, so a bit of an example of what it means to have divergence on the indicators to the market and the reaction from the market to it. So when you can see over here, I've got the market right here making higher high, and what I've got here is these indicators also making higher high. So I'm okay with that, right? This is something that I'd like to see. Now the next one comes in and I've got another higher high in the market, but look what the indicators are actually doing. The indicators are making lower high. So what I've got here is a sign of a divergence. So when the market pull back, I need to think twice. Is this a good place for me to enter higher, or do I think that the market is going to stall around here or just go and change direction? Something is about to happen. And as you can see, the market actually put a lower high and continue lower to make a lower low. It doesn't always happen, by the way. It doesn't always happen that when you have divergence straight away change direction, but it does give you a warning signs that we're running out of momentum. When you take a look at this example right here, so as the market is making lower lows, indicators are also making lower lows over here. But the market made another lower low, and look what the indicators have done. Very, very obvious higher low right around here. Okay, and then what it means that if the market pull back into this area, do I look to take it short? Probably no. There's a big warning sign here that tells me we're running out of momentum. And as you can see, that short was a very short-lived move because right here we've got a rejection and a continuation higher. Again, doesn't mean that from here it wouldn't go lower again. But if this was my entry, then I would have got stopped out. So what it helps me do is assess the likelihood of a market continuing in that direction. It basically just tells us a bit more about the momentum in the market, which is what really we're after. It's really what we want to get from these indicators. So let's look at combining these ingredients, putting them all together. Now we haven't covered all of the ingredients that we're using for our opportunities. It's just a couple of them, but you can see how by taking all of these ingredients together, we can start to build up a trading strategy. We can start to build up a trading decision. So what we're looking at first of all is the chart structure. So we want to look at something that we call an optimal chart structure. We don't like big wicks. We don't like too big erratic candles because I talk a lot about indecision in the market. We want to see a nice trending chart, so nice flowing chart either to the upside or to the downside. We want to see a trending market. We want to see significant levels of support and resistance, and the stronger the level is, the stronger the reaction to it will be as well. 2 touches is a nice level. 5 touches, 6 touches is a very nice and strong level. We want to see the indicator converging on the MACD and on the RSI. That basically tells us there's momentum in this market, and I want to see confirmation on multiple time frame. And usually when we look at multiple time frame is a multiplication of 2. So if I'm looking at the 60 minutes, and the next time frame up will be the 2 hours, and then the 4 hours, 8 hours, and then the daily. So you can look at as many time frames as you want, but really I'd like to have at least 2 time frame in agreement with my trade. So if I do intraday, 1 minute, 2 minutes, 5 minutes, and 10 minutes will be what I like to see. Even 15 minutes, I'll look at it as well if I'm looking to take off the 1 minute. So where is the 4 hours? It is important to know, would it affect the direction? Not necessarily. Okay, so they need to be in close proximity to each other. So let's have a look at an example and then see how we can utilize it all together with the contract on Nadex. So actually, you know what we'll do before we head into the example? Let's have a couple of minutes break so I can fill up the water bottle and all that. What time? It's 48 minutes past the hour. Let's take about a 7 minutes break. So let's come back at 55 minutes. Oh, it's 49 already. I'll put a little clock here so everybody will see. Let's come back around 56 minutes past the hour. And if there's any questions so far, please feel free to type them in the question box and we'll answer them as we come back from the break. So let me get that clock. Okay, let's do 7 minutes. Okay. All right, welcome back. Okay, oops, I got a really good question that came through, so let me read that through you. A lot of time I enter the market when I see a trend just to witness that I enter at the end of the trend. How can I avoid this? Thanks. One of the things that we've seen with a lot of new traders is that they enter as the market had a move. So they're waiting for the market to move, and then once the market has done that move, they look in at the entry, and this is really when the market is about to pull back. So there's two things that I read from your question, and correct me if I'm wrong. Is it a trend that is end, or is it just a pullback? Because there's two different things. Sometimes you cannot tell that a trend is ending, just sometimes it will be because of news. So one of the things will be to check the news. If you're looking to trade anything, let's say an example, you're looking at euro dollar, then you need to be aware of any news that are going to affect the euro, any news that are going to affect the dollar, because they can change the direction of the trend. So that's news that can affect the market. The second thing is looking at divergence and convergence, because that will help you assess if this market is running out of momentum or not. Looking at higher time frame, if the higher time frame is diverging, there's a very, very high likelihood that the lower time frame are going to change direction. So that's one of those things. Another thing is, say you still have convergence on this higher time frame and you're looking to trend the lower time frame. However, if these higher time frame are very overextended, and when I talk about overextended, what I'm talking about is the distance between price action and the moving averages, the 10 and the 20 moving averages, what you'll find is that this, when the higher time frame needs to snap back into the moving averages, because they always do, then it can't just be selling and selling and selling and selling without some sort of release of that selling pressure, then you'll find a lower time frame changing direction as well. So it's a combination of a couple of things, right? You have to be aware of the higher time frame, where they sit and what they're doing, because if these higher time frame are overextended, if these higher time frame are diverging, there's a very high likelihood that the time frame that you're looking at is going to reverse. And another thing, and this is out of your control really, is events that happen in the market that no one knows about, and that's just trading, and this is part of the risk. And then there is event that you can know about, which is on the economic calendars, which is very much recommend that you have a look at for any market that you're looking to trade. And then the other thing is normal pullbacks in the market. Okay, so market cannot just move in one direction without any sort of pullback. There will be pullbacks, and you have to see the relationship between the time frame to know how far this pullback can occur. I can give you as an example what happens right now. If you look at the in the index market on the weekly, they're very much overextended from the moving averages. They're sitting at levels of support and resistance, very strong levels of support and resistance. Now, that's not to say that this is a place that we should buy the market. Absolutely no. But this is sort of a place where I would say, if I was a seller right now, what would I look to do? I probably look to close my position, or I probably look to not take another selling opportunity right now, because we're sitting at support and resistance level, because we're overextended. So I might look to be a bit more cautious about my approach into that. The market has been selling for 3 weeks. You know, there is that element of sitting on support and resistance, so that creates a bit of where are we going to from here right now when we have that overextension and all that. So you have to sort of analyze for yourself how much, when you're looking into an opportunity, really even give it a score. What do you think is the probability of that opportunity? How strong is that opportunity? Did you enter into the opportunity just because the market was selling and selling and selling and selling and you wanted to be a part of that? Or was there a really technical reason that even if you look at it a year from now and you look at the screenshots of your trade, you'll say, yep, definitely an opportunity there. So that's another thing. That goes more into psychology of trading as well. If you're chasing the market, or is it really good opportunity? So big answer. There's a lot of things that can come out from the technicals to the psychology around trading. So I hope I've answered your questions. Okay, so let's continue. So let's have a look at this scenario. So we're looking here on the ES on the monthly, and you can see that there is a level right here. Now, honestly, I think the level sits somewhere around this area. This is too high from where it is. So in my opinion, we are going to see a pullback into this area right here. There's more touches around that area. But you can see that we're sitting right there on the monthly. It's a little bit overextended. It's not too much. So let's continue and see where the market is sitting on the weekly. When we're coming into the weekly, and this is why I'm not in love with this example, but it's good to show because it's good to see all sorts of reasoning and how you can read the charts as well. So when we're looking here at the weekly, the first thing that I can spot is that we are in an uptrend, right? We make a clear series of higher highs and higher lows. One thing that bothers me is that we have divergence, and this divergence is very strong. You can see this is a three waves divergence. So market make higher high, indicators making lower high. Market made another higher high, indicators are making another lower high. That to me spelling a pullback. It could be this pullback is not over. It could be that it pulls back just a little bit further. So by the way, we call this area between the 10 and the 20 moving averages the precision zone, or in an uptrend a buy zone, or in a downtrend a sell zone. So when I'm looking at this area, there's another thing that bothers me. I've got here a rejection candle of the 1700. So I've got here, you can see that 1700, and by the way, round numbers do offer levels of support and resistance. It's a psychological reason. It doesn't need to be, there's nothing more special about them, but our market is moving by emotions, not just by technical. So when traders see lots of zeros behind the number, they see it also as level of support and resistance. So you can see there is a clear touches over here on the 1700 and a fall from it. We came up, and now on this week we completely rejected that 1700. That to me also spell a deeper move lower. It doesn't have to be, you know, coming down into the 1500, but it just means that along from here might not be the best opportunity. So I've got the monthly that the level sitting a little bit below, and I've got the weekly that the weekly really spell for me another push lower. But let's see how the daily looks like. Now, the thing with the daily, when the daily comes into effect, is that we do sit on a level here on the daily, because you can see I've got a touch here, few touches over here, another touch here, another touch here. There's a couple of touches here on the daily. So what can I sort of get from this information? There's a little bit of contradiction information, because I could see the weekly pulling back a bit further. I could see the monthly pulling back a bit further. I can see the daily sitting here on support and resistance. What I can look to do is spread my bet on this scenario, because yes, overall we are in an uptrend and we're sitting here on a level. We might get this to move higher, but we might see a dip, like a bit more of a pullback coming out of this one, and then a continuation higher. So a weekly opportunity might be something that I will examine, or something that goes into a much lower time frame that just look at the reaction to this level. And if this level is broken, then I'll wait for the next level to be offer me support and resistance level. So let's go down the time frame. What I see here from the 4 hours is that we're starting to reject this level, but you know what? It's not a really nice trend. I mean, we cannot by any means call it a nice trend. There is some downtrend going on. There's a rejection of the high and a downtrend, and currently what we have here is a rejection candle of the low. But I do have convergence to the downside, and we haven't yet broke the high of this candle. So not loving the 4 hours at all. When I'm looking at the 1 hour, you know, the 1 hours is still in a downtrend. When you look from this low to this low, we're still somewhat convergent to flat. It doesn't spell a very much bullish move. And we are not very much overextended as well from the moving averages. So there's nothing much that says to me, I'd like to buy over here. So there is some sort of a contradiction between the information. And personally, what I would have do is waited a little bit around this area. I like the daily, I don't like the weekly, and I think the monthly can keep on going a little bit lower. So you take all this information, there's nothing I would like to see, and this is another thing, this is what I like to do is when I look to trade on a higher time frame, I'd like to see the lower time frame change direction, because if the higher time frame is pulling back, right, and the lower time frame is still downtrending, then to me there's nothing there that says we're going to reverse. I need to see the lower time frame changing direction as well, and I don't have it here yet. So I might look to wait, or I might say, you know what, this is a really good opportunity on the weekly. What I look to do is take a weekly binary of this one. So having that assessment of the situation, of the levels and all that, let's see what sort of binaries and spreads we can take out of that scenario. Now remember that spreads are only, they're expiring on the day, so we can't look to take them on the weekly. So if my assessment dictate at the end that I actually like it for the longer term and not for the short term, then spread will not be my chosen vehicle. I would look to take the binaries. But let's assume that I like it for the long side from the area that it sits right here. Then let's see which is the best spread contract to trade and why. And this is something that, you know, it's a good kind of sentence to remember: to buy at the floor and to sell at the ceiling. We want to be as close to the floor when we're buying, because that gives us a high reward to risk, and as close to the ceiling when we're selling, because that again gives us a higher reward to risk. So if we know that the market sits around the 1666, which would be the best spread for us to take? Let's examine a couple of scenarios and look at the reward to risk that come from this scenario. So the first scenario, we're looking at the floor of 1650. So we're actually sitting somewhere in the middle between the floor and the ceiling of this spread. And what you can see here is that my maximum loss is 168 and my maximum profit in 232. So really, if I've got a big push out of the S&P currently from now, then I will be a bit further ahead, probably 1.4 to 1 out of that scenario. But I need the market to expire above 60.90 in order to generate me the maximum profit of this spread. So I've got 16 hours to do that. And, you know, while not out of the question, because anything can happen in trading, it is a huge move. And I probably am not going to make the move that I'm after. So this spread might cost me more than what I'm looking to make out of this one. So we need to see if there is a better choice for us. So actually there is. We're looking at the 60-70 floor. Now the market is not there yet. Remember, the market sits at 1666. However, I'm expecting a move in the market and might not get into the 1710, but I can still make a nice move out of this one. Even if the market is rallied, there's a nice profit that can come out of that one. You can see that the maximum loss versus the maximum profit, we've got over a 10 to 1 out of this scenario. So it's important to know which of the spreads we are looking to take. Okay, so these are when you think about the spread, it's really important to look at your maximum loss and your maximum profit, and also assess, is there a high likelihood for the market to move into that direction? I've got about 16 hours for the market to do that. So if I'm very, very bullish, I might choose this spread. But if I'm not quite certain that the market is going to jump from here, maybe I'm thinking the market is going to have another dip lower and then move higher, then you know what, that might not be the best option for me. So choosing your vehicle into what you're looking to trade is very, very important. So when you're looking at daily binaries, you also have more choice in your expiration. So that's why a lot of the time you'll find that we're talking more about binaries than we do on spreads. It's not because one is better than the other. It's just sometimes we have better choice for the expiry, for the strike prices than we do on the spread. So let's have a look at what sort of binary can I look to choose. And by the way, I can mix and match as well. I don't have to take everything on the spread or everything on one binary. I can look to do maybe a 1-to-1 on the binary and then the rest on the spread and so forth. I can mix between my vehicles that I can use and the different strike prices as well. So when we're looking at the daily binary, we're looking at a one-to-one. So we're looking at something that's really close to where the market sits right now. I don't need the market to move a lot in order for it to close above 1667. And that is also reflected in the price. It will get somewhere around the one-to-one. So this is a very, very conservative option. You don't need a lot of movement. The market just can go sideways from here and you can get your profit. You can also look to close it ahead of time. So in these scenarios, sometimes 16 hours is a lot of time. And if you're looking to trade it, there's a 16 hours, you're already there in the profit, and then at the end of it, it expires worthless because the market kept on moving. It can be sometimes very annoying that you saw a market and you were right for a certain period of time, but it expired worthless. So you can still close it manually as well, or you can put a limit order to close it if it gets to a certain level and you can sell it out. So it's another way of protecting your profits as well. The second scenario is the next strike price, and that one gives us about 1.5 to 1. It's again, you don't need the market to move that much. I mean, we're talking about 3-4 points for the market to get there, but we still need to be slightly more bullish than bearish or sidewaysy on that market in order to get there. You can go even more aggressive. You can go above 1676, but remember, we're talking about 16 hours for this market to expire, and we're looking at a big move. So we need to be very, very certain that the market is definitely going to bounce from there. Now, if you remember the way the 1 hour looked like and the 4 hour looked like, it didn't look like we're going to bounce definitely from that area. So I wouldn't go very aggressive on that scenario. If I like the bounce off the daily, but I didn't like the lower time frame, I might not choose to be very aggressive. Okay, so the further, obviously this is a cheaper contract to buy, but you need to think what is the likelihood that it's going to expire in the money. Okay, because the reason why it's cheap is because there's a less likelihood of the market to expire in the money at that time. So you need to be very convinced in your decision that the market needs to move from here, and it's going to do so in the next 16 hours. Another scenario that you can look to take is a strike price that is lower than where you're sitting right now. So you're actually buying an in-the-money option. The problem with that is that your maximum loss is going to be bigger than your maximum profit. Okay, so when you think about how many trades you needed to go to target versus how many trades you need to go to stop in order to will end up going to stop, where what it's going to do to your underlying result, you really need to have a lot more winning trades than losing trades because of that win-loss ratio. So a lot of traders says that if they can't get a one-to-one out of an opportunity, they're not looking to take it. That's one way to look at it. Another way to look at it is if you're choosing to take an in-the-money option, you need to be aware that you need to win more and significantly more times than you lose. But then again, the market can do absolutely nothing and you will expire with profit. Okay, but you still run the risk that the market is going to go lower and you're going to lose almost twice as much. Okay, again, the ultra conservative, you're going very, very deep in the money, so you're only going to make about $20, risk about 80. You're risking 4 times the amount of what you're going to make. So you must make sure that you are winning more than 4 times the times that you are losing, because every time you lose, you are going to eat the profits of 4 winning trades. So it's a really hard win-loss ratio to come by. Okay, it is easier because in a way you are ultra conservative and you say what's the scenario, what's the likelihood of this one going below 1658? Well, you know what, it can happen. This is trading, right? So you need to be aware that when you're having this very ultra conservative in the money option, then you have to have a much higher win-loss ratio. So calculate them both, the win-loss ratio and the reward to risk, and you come up with a number that we call expectancy. And if at the end of this calculation you have a positive expectancy, then it's all good. At the end of the day, you can see a black in your account. But if you come up with a negative expectancy, then you have to ask yourself the question, is this the right way to trade for me? Because you don't want to have 5 winning trades and then 2 losing trades, and you think, oh well, but my win-loss ratio is really good. However, your reward to risk is very bad and you end up in the red. So have a think about that as well. Okay, so another option that we can take is the weekly binary. So if I think that the market eventually is going to get there because I'm looking at the weekly, but I'm not sure it's going to do that within today, then I can look to take the 4 days expiration. So I've got almost the entire week ahead of me for the market to rally. Obviously, you will pay more for the time value in that binary, but you can look to, again, mix and match. So I can say, all right, I'm going to take maybe closer to the money or slightly the next strike price out of the money on the daily expiration, and I'm going to take another one, say, that can give me a 5-to-1 on the weekly binary. So it's sort of like a hedging against when the move is going to happen. So that gives you another opportunity to look to profit from a weekly move. Again, because the 1 hour and the 4 hours were not up to scratch, in my opinion, then I probably would have gone for a weekly binary, because of the thought is, what is the likelihood that the market is going to hold here and move higher from here versus the higher time frame are moving, the weekly looks nice, the back into the buy zone, and the monthly, therefore I'm expecting a higher time frame move, and therefore I would look for a higher time frame binary. So if I'm looking for the conservative one, then I'm looking at something that sits in the money. I don't need the market to move at all, but the thing with that is I'm buying an option that I'm paying a lot for in time value. I'd like to get something out of that. If the market moves quickly and I would like to close it, I will not be even close to the 100 because of all that time value that is left in that binary. So it's something to think about when you're going the conservative way, is how much you end up losing on the time value aspect of the option. The second thing that we look at is another conservative one. We don't need the market to move a lot, but we can make a 1.5 to 1 out of that one. And there is a 4 days for the market to go. We're not looking for a big move. We're looking about, 8 points max for the market to move, and I'm looking quite good. The S&P can do that within 4 days, but I really need for it to get my maximum profit, I need it to expire above that level. And you know what? It could do that within a day and then pull back out of it. So it's again, this is the sort of race that we're running with it within a longer expiry option. We can go very, very conservative again. You can go above 1649.5. You know what? It's very far out of the in the money. We need a very extreme decline for that to happen. Again, this is the same kind of question that you need to ask yourself. Can I get a much higher win-loss ratio with this type of trading to offset the losses that could occur if the market goes against me? So it's a very important question to ask. At the end of the day, you're going to have a positive expectancy. So being more conservative doesn't necessarily mean being in the black at the end of the day, just as being more aggressive doesn't necessarily mean being in the black or being in the red. So we're looking at a more aggressive situation right now. We're looking at, we need the market to rally about 20 points in order for us to get to this scenario. Now, we're talking about 4 days, 20 points. You know what? We can get about 5 points a day in average. That's doable on the S&P. So it's a really nice reward to risk that we can get out of this one. it is aggressive, so therefore I can look to mix and match. I can say, all right, I'm going to take a daily on a 1-to-1 and this one on about, it's almost 3.5-to-1, somewhere around that. So maybe this is something that I'm looking to do. Or I can even be very, very, very aggressive and say, oh yeah, I think there's a huge move coming up and I can take the next one up. It can happen, but the question that you need to ask yourself, and what I like to do as well, is if I'm looking, say, over a 4 days move, I look at the last recent 4 or 5 days and I see what was the size of the candles. Because if the size of the candles were 2-3 points, as an example, and it doesn't have to be the daily, it's just the last period that I'm looking at, so the candles, if I'm looking for a 50-point move as an example, and the market move each period for 5 or 6, then probably I'm not going to get that. I'm looking at the average size of the candle, all right, to kind of anticipate what sort of likelihood of move am I expecting. Another thing that I'll do, if, as an example, there was a level of support and resistance sitting at, say, 1693, then I won't be using or utilizing this contract, because I'm also expecting not only a big move in the market, but I'm also expecting the market to penetrate through a level of resistance just to get me into my expiry contract. And that's too much for the market to move in a certain period of time without stopping. So I'm looking to not have areas of support and resistance in the way as the market is traveling into that contract. So when you choose those aggressive contracts, pay attention, is there a level of support and resistance, and what is the likelihood for the market to actually travel this distance in order to get there. All right, so let's have a look at our entry. So say this is where the market is sitting and we think that this is a good place to enter. And by the way, as we look at this daily, a little bit more zoomed in, another thing that I don't like is that we have lower highs here on the daily, sorry, lower lows. So from this one to this one to this one, we still have lower lows. Yes, we have a rejection candle currently, but if we've got 16 hours left on this candle, it might not close like this. It might close big and bearish and inside that level. So looking at the daily, I must say I don't love this opportunity for the long side currently from here. Yes, there is a nice support level right here. I probably might look to see a rejection on a much lower time frame than I would to take this on a daily. So let's see what happens. So we're looking here at the results, and this is, what time frame is this? I can't see the time frame, but you can see that the market actually traded lower, had a rejection candle of 60.40, a break above that, and this is really a more of an indecision candle, because you can see the high and the low of the wicks are quite the same. We have a small body in the middle. This is an indecision candle. When you have an indecision candle, this is just a sideway notes about candle reading. If I've got a break of the low of this candle, then it's just a continuation of the selling. But if I've got a break above the high of that level, then we're actually changing into a more bullish move. So an indecision candle is basically tell you the control of the bearish, so control of the sellers in the market is starting to run low, and if I get a break above it, then it tells me there's more buyers in the market. So indecision candles are very important, but it all depends on where they are in the trend and what follows them. Okay, so it's a little bit different than a rejection candle. Okay, so anyway, looking at what happens around here, I've got this big rally that happened in the next couple of days. This is the daily chart, so we can see that if we had taken, no matter what kind of daily contract we have taken, we would have ended up losing on those contracts, but would have ended up making money on the weekly contract as well. So it's always also a good idea to think about changing a little bit the time frames and not having everything on the same binary or the same spread, but actually looking to have daily expiry, 2 hours expiry, and also the weekly expiry as well. So if there are any questions about this example, if not, let's move into the next example. And I think this the question about what's available when on the platform, I think the best way to do is contact Nadex. They can give you a better answer and a more precise answer on that. Okay, so for the person who asked about different times on the binaries on the S&P. Okay. just contact Nadex for that. So is there any questions about the example? Because you'll find there is changes in what's available depending on the underlying market and the opening time of the underlying market as well. Okay, so let's move into another example. We're going to look at the Nasdaq, and we're going to see again how we utilize in levels of support and resistance, and we're going to analyze the charts again and see what sort of contracts we would like to have a look at. All right, so we're looking here on the Nasdaq on the weekly, and you know what, this looks a lot better because what we've got here, we've got convergence here on the MACD. We have flat on the RSI, so they kind of they're sort of like neutral more. If we don't have that strong divergence as we had on the S&P, we right now have a nice convergence and flat on the RSI. We do have a pullback into this level. We can see around the 31.55. The one thing that we need to pay attention is currently we have a very bearish candle as we're pulling back. So we need to see that we're actually rejecting this level in order to see if we can take this higher. I like the touches. There's another touch here and another touch over here. It looks to be a very nice level. And we're also back into the buy zone, and we are in a very nice uptrend. Let's take a look at the daily. Now the daily actually broke the uptrend. We were in a nice uptrend on the daily. We found resistance here at 32.50 and we're starting to fall. It looks like the market is reacting to this level, but you know what? It's a big selling day over here. We need to see how long we have till expiry. We need to assess how far we're looking to drive this market. But there's definitely, we can see from this rejection, there is a reaction to this level, and we can see more precisely this level sits at 31.40. Let's continue. Now this is, by the way, when I talked about overextension, this is exactly what I mean. When I've got, this is the 1 hour and the 2 hours, and there's no denying this is in a strong selling momentum, and you've got convergence here to the downside. But what I also have is I've got here, this is the level that I'm rejecting. I've got a rejection candle here on the 1 hour. So far, a rejection candle on the 2 hours. Mind you, this one hasn't closed yet, so it could still close bearish. You can still close indecision. We haven't closed that candle yet, but on the 1 hour we did, and it is looking bullish. I've got overextension. Now, the whole idea with overextension is that we don't know when, but the bigger the overextension, or let's call it the distance between price and moving averages, the higher the likelihood that we're going to see a snapback into the moving averages. That's not to say that every time I see this sort of scenario, an overextension, that I'm going ahead, jump and buy. I need more reasons. So one of the reasons will be if we're bouncing off a level of support and resistance. The other one would be if I've got divergence on the higher time frame, which by the way we did not. But if you go back into the daily, you can see there's no divergence that will spell a bullish divergence, so looking to go further. But we do have a bullish weekly as well. So there is a case to say, all right, we're bouncing off a level. We are overextended on this 1 hour and 2 hours, and we are looking bullish on the weekly. We might see a nice bullish move here on this move. Mind you, though, the cautious side will be we do have a very big selling candle on the daily. Another thing that is interesting about index market is a lot of the time, and this is by no means a proof of concept or anything, but I do find that when we're coming closer to the close of the market tends to reverse the direction of the daily, simply because a lot of traders will close the intraday positions that they have. So if we had a very strong selling pressure, then coming into the last couple of minutes or last couple, 15 minutes, 20 minutes, 30 minutes, we'll see a reverse of that. Doesn't always happen, obviously, not something that I would generate as a trading strategy, but it's just another something to add if this one is coming into the close of the day. Well, we don't know yet where it sits. Now, right now, you can see that we have 30 to 45 minutes close to expiration. So adding all this information up, could we see a snapback into these moving averages right here? Could I see a nice bullish move into this area? I wouldn't look to buy it on a very long term at this point in time, because I could say I don't know if this one is going to continue lower, if this one is going to reject that level. We had a very strong selling pressure today, but however, we're still rejecting that level. So on the weekly, we might still look okay. So the question is, if I had, say, for example, 16 hours to go, would I buy the daily? That would be an interesting question to ask. But for the weekly, I could say from a weekly perspective, we're sitting on a level, we're rejecting a level that could be a nice entry for a weekly perspective. So both of those scenarios can be valid. So looking at this currently, we've got about 30 to 45 minutes until expiration. So we can't look for something that is so very, very aggressive, because we need the market to move a lot in order to get us an aggressive type of a move. So if we're looking at the spreads, what we've got here on this spread, we've got the market sitting right now on 31.56 or closer to 57. And the spreads that I've got a 30-point spread sitting between the 50 and the 80. So you can see at the maximum reward to risk that we've got is actually quite all right. It's about 2.5 to 1. However, remember, we don't have a long of time until this market is due to expire. So the question that you need to ask yourself is, can I get there within the amount of time that is left? And it's going to be quite a huge rally for the market to get to the higher level of that spread in order for us to get the maximum profit out of that trade. So might not be the best choice or the best vehicle to choose currently. So another possibility is to look for a daily binary. So we're looking for the market to rally about 5 points until the market is closing. The reward to risk is looking quite good. It's a little bit over 2 to 1, but we need it to rally about these 5 points in order to do that. So we need to look back again. Let's have a quick look at these levels. And if I'm saying, okay, the market could come a little bit into these moving averages, you can see that the moving average is sitting around the 38.80. I don't need a big move right here in order to get that 5 points. If you look at the chart in itself, the move on the chart is not a very big move. So I could say it is doable for the market to do within this next couple of minutes, just move 5 points higher. And that will get me into my profit on this. It will get me a bit more than a 2 to 1. But again, I'm going counter trend, and I need the market to rally within that time, because even if it's going to rally 50 points after that, so in the post cash market close movement, so when the futures are still moving, I won't be able to get that scenario. I won't be able to get my profit. So it's very important to make sure that you're getting the correct vehicle and also the correct time expiry. So another option that you can look at is a bit more conservative, and you can look at just a rally of about 3 points. That's not a lot, and you can look to make a 1-to-1 out of this time. Now, if you think that the market have a higher likelihood of going there, and you think it's going to happen within the next couple of hours, then you can choose the weekly binary, but just make sure that you understand that you're paying for the time value. You can obviously close it ahead of time and you can make a bit of a profit, but you won't get the maximum profit out of it, because the maximum profit is only at expiry, where the time value is no longer has any monetary value in it. Okay, so when you look at a weekly binary, it might also be a good idea to take something that is close to the 1-to-1 and something that is also a little bit more aggressive that can get you a higher reward to risk. So it really is depend on the time that has up until expiry, but when you take in the weekly, make sure that you understand the cost of the time value in it. So when we have on the weekly 3 days to go, and if you remember, we're looking for the market to say snap back into the moving averages sitting around the 31.80. You can see that it gives us a really nice reward to risk around this area. And I can look to do that. And even if the market, you know what, at the end of the day will not rally into that area, or maybe rally into it but then move away, I can put a limit order to take my profit when the market hits that area, and then I don't care if the market continue lower. Yes, I'll lose a little bit on the time value, but I made the money on the counter trend, on the move that I was anticipating. Okay, so let's see what happens. So we look to enter around this area, around the 31.40, and again the market pushed lower from that, so the daily expiry would have not worked for us, but the weekly expiry would have gone quite nice as well, and you can see it really went all the way above the 31.80. So a question came through, when to close or when to leave this open if I still have some time value. It really is up to you, but what I like to do is, if I look at the lower time frame, so say for example we have bought the 31.80, I think it was 31.84, yeah, this one over here. So say for example, this is the day that the market has closed, we rallied all the way up and then it pushed back into here. So it's around the 31.92, which is about, let's say 8 points from my my strike price. What I like to do is I look at the lower time frame and I see if the lower time frame started to trend really beautifully. I've got a nice uptrend happening on the 1 hour, and this area, the push lower on this candle was just a pullback on the 1 hour, and we are looking to continue higher again, then I would leave it. I would leave it until expiry because I can get all that time value out of it. However, if I can see that the market's finding resistance somewhere or there's more bearishness coming into the market, then I would close that binary. So it will be a manual close, and it will be a decision based on the fundamentals, okay? Because I wouldn't want to take a profitable trade and turn it into a losing trade just because I was trying to get a little bit more out of it, from the time value and from the full expiration. If I don't think that the market is going to continue higher, so for that I would look at the lower time frame, and I would also look at the weekly, then I would close it manually. But if I think that the market has it in it and I'm already far away and in the money, then I will keep it as well. But I do like to keep an eye on my positions. I don't like to not notice and not see what they're doing, but it doesn't mean that I'm checking them all the time. Okay. What do you mean by 37? I've got a slash and a 37. I don't know if it's a question or what comes from it. So let me know if there's a question there. Oh, it was a mistake. Okay, no problem. All right, do we have any further questions about the Nasdaq example or any other questions about the technicals? Look, the technicals are very important. They help you assess the opportunity, the likelihood of that opportunity. So there's a lot of information that you can read out from the chart, but combine it with the higher time frame to give you a higher probability trading opportunity, but also utilize the correct contract is very important, because sometimes you can say, I am sure, like in the morning today, you had the Aussie yen sort of rallying in the Asia session in the morning, in the Asia session, and then for some reason started to fall off. And if you say, okay, I'm taking this on the daily, you might at the end of the day, once the Europe open and once US open again, you might end up in the red. But if you have taken, say, something of a 1 hour or a 2 hour, or you decided to close it, then it would have ended up in a profit. So it is very important to check the time frame that you're trading off versus the contract that you're after. It needs to match. Taking a daily contract when you're trading off of 5 minutes, that might not be the greatest decision or higher probability, let's put it this way, trading opportunity. So match the time frame that you're after with the time frame that you're trading off. Okay, so the time frame of the expiration. All right, so a bit more about how we can take your trading further with Nadex. So first of all, you've got really nice tight spreads and low cost, because what you're looking at is when you trade in binaries and spreads, the exchange fees are very low, or relatively very low, and what you've got is 90 cents per contract, and it caps at $9 per order, and the spreads are very nice and tight. You can see the spreads over here in this example. This is a live screenshot of bid and offer on the S&P. You can also have 24-hour access to market. So we're looking at availability to trade whenever you have the time. You know, we don't have to trade, you know, when you're at work and the market is open and you go, oh, I missed all those opportunities. There's other markets that are open and available for you whenever you've got the time. So when you come home, you have the dinner, you do whatever you need to do, you do your scanning. There's a market that is open, and there's also the futures market that are open on the S&P, the Dow, the Russells, and so forth. So a lot of opportunities to trade. You also have got the forex, you've got the commodities as well. They're open. The forex opened 24 hours, 5.5 days a week, and the commodities market also opened quite similarly to the futures market on the index. So a lot of opportunities to trade. Could you please explain bid size means? Oh, okay. So talk a bit about the spreads. Okay. So when we're looking at entering into an opportunity, you'll find two quotes, one for the sell and one for the buy. So bid is for the sell and offer is the buy. And what you'll find is that, say the market sits, let's take easy numbers, say the market sits midpoint at 100, and we're talking about a spread of 4. So if you're looking to sell that market, you will enter into the market at a price of 98. And if you're looking to buy, you'll enter into the market at a price of 102. This is just as in general, okay? I'm just taking easy numbers. That difference between the 98 and the 102, it's called the spread. And that is usually part of, let's call it the cost of doing business as a trader. Okay, so the moment you enter into an opportunity, you will be in the red until the market starts to move in your direction. So bid is really the sell price, and offer is the buy price. It's just another name for it. Okay, and it will never, excuse me, it will never be the same because this is where the profit that comes to the exchange and to the brokers as well. But what you were looking at is bid and ask, or bid and offer, or buy and sell price that as close as possible. So that's what we call a tight spread, because a tight spread also means the cost of doing business for us as traders is lower, because the cost that we're paying really is commission and the spread. So you add it up together, and this is the cost of entering into an opportunity. Okay, so bid is the sell and offer is the buy. All right. Okay, all right, so let's continue. Thank you, fantastic. All right, so when we're talking about leverage, you know, leverage can be extremely dangerous in the traditional sense of trading, because you know, when you trade futures, you can end up losing a lot more than what you planned. You don't have that with Nadex, because even though they're highly leveraged, it is on the cash basis and the risk is limited. And I cannot stress this enough, how important managing a risk is. I can give you an example from my own experience, and you might have heard this before, but I think it's quite amazing. I was trading dollar yen. The market was going in my favor, so it was very close to expiry and everything looked good, and suddenly there was an intervention on the back of Japan, and within really milli of a seconds, a nice trade that was in profit turned completely the other side. Like, there was over 100 points within milliseconds that the market has moved, and I was watching it as like, wow, if I was in an ordinary type of trade, there was no way I would have been able to exit that position on my full regular risk. So if I say my risk is a 1% of my trading account, there was no way it would have ended up with a 1%. There would have been slippage. The market just can't fill me in on my stop loss, or my traditional stop loss, when there is this sort of scenarios in the market. But because I was looking at binaries, nothing happened. You know, the market went completely against me, like massive amount of points against me, but the risk was still the same. I did not get caught up in that scenario. And you know, these interventions, it's not something that we can plan for. It just happens. This is the sort of risk that comes in the market, especially in these days and times when there's so many intervention in the market. Half of them we are aware of because we expecting, you know, the Fed's decision and the Fed meeting and all that, or the ECB that's coming up today or tomorrow I think, with the interest rate decision. We know that it's going to have an effect on the euro dollar, but sometimes these interventions are happening in the market. A central bank decide to go in and buy bonds or sell bonds or do whatever they do, and that affects the currency market, and that would affect our position as well. So the fact that we have limited risk is a huge advantage, because if I end up just losing my 1%, it goes into you know, the whole scheme of things of win-lose ratio and reward to risk. But if suddenly I took a 1% and I turn it into a loss of 3%, now I need 3 winning trades of 1% or 1 winning trade of 3%. I need more to recover my losses. Okay, so having limited risk is a huge advantage. So there you won't get to lose more than what you've decided to risk on each and every given trade. And what I also like is that when you enter into a trade, you're not in you know, unknown of how much you're going to make or lose. It displays for you your maximum loss and your maximum profit before you press in the button, before you entering into that trade, before you send the ticket in. So you know, if you need to calculate your position size, which by the way, it's a very important thing to do as a trader. Say for example, my position size is 500 and I'm looking at a trade and the maximum risk in one contract is $100, then I know that I need to put 5 contract, and I can put that in and I can see the numbers changing, and I can always be as close as I can to my position sizing, so I can always know how much I'm risking. So you're not living, you're not there unaware of what happens. There's a lot of you'll find there are platforms that you don't quite sure how much you're actually risking, and you just if you add one more zero, you end up risking 10% instead of a 1%. So having that visual confirmation of the amount is very important, especially when you're trading intraday and you're doing everything fast. You need to be able to see your risk quite clearly on the ticket. You also have direct market access. So if you remember when I explained a little bit about the bid and the offer, that spread, and I said this is the cost of doing business. Sometimes you can say, you know what, I want to go inside the spread. I want to tighten the spread so you can make the market on your own. So you can decide that you're going to put an order to get into the market at the price that is between the bid and the ask, or between the bid and the offer, and that would be if there will be another side there that is willing to take that on you, you will get triggered into that market. So you don't have to accept the bid or the offer. You can actually put an order to the amount that you want, and that is the advantage of having direct market access. You've got 100% capped risk on every trade. So we talked about this quite a lot. And it's a very important characteristic of trading the Nadex options. And therefore, you don't need a stop loss. And one of the things that I like is that even sometimes, you know, I've got 2 hours till expiry and the market dipped into where usually my stop loss on the traditional way would have taken me out. The market can still rally from there, and I can end up in the black. So I don't get stopped out. I allow all the time value for the market to do its thing. And you know, yes, it can happen that the market will move there after expiry. These things happen. I mean, you can't say that it never happens, because it does. But a lot of the time, if we calculate correctly the time that we need for the market to move and the situation, you don't get stopped out in the middle on spikes on the market. And lately there is a lot of spikes in the market, and then traditionally you will get stopped out. It won't happen with Nadex. So it allows you for the opportunity to actually mature and go into that target. You can also look to trade when you don't have a clear direction, as I said, about on levels of support and resistance. You can look to trade on big news as well. So this is something that I would never ever do on traditional sense of trading because of the slippage, because you can't get out of a position or into a position when the market moves so very fast. However, when you are on a binary and you know that this is the amount that you're risking and nothing else is going to take you more than what you're risking, you can look to trade. If you have a view of the news, if you think the market is going to react to major news, then you can look to profit from that as well, knowing that your risk is capped. So we don't need a stop loss really when we enter into the market, because we have a fixed risk trade, and therefore I don't need to go ahead and put the stop loss. You will find us talking about where would my stop loss would have been, where we're talking in the advanced course, when we're looking at the scenarios, the strategy itself and what we're looking at. The reason for that is because it helps us calculate what is a 1-to-1, what is a 2-to-1, how much am I looking for the market to move. It's not because I need to put a stop loss, it's because it helps us calculate our reward to risk, and it's something that is important to get into a habit of doing if we're looking to see what at the end of the day is our expectancy. And it's two figures that are very important for you to have as a trader, and I would recommend keeping a log of your trades and of your results so you can actually have that number. So even if you have 3, 4, 5 losing trades in a row, if you know that you have a higher expectancy or a positive expectancy, you know that this is just probabilities and this is just how the market works. Because when you know, for example, I've got 70% win-loss ratio, say on a 1-to-1 reward to risk, I could have 3 losing trades in a row. I could even have 6 losing trades in a row, and it will be just a part of probability, but I need to have it in me to be able to place the next trade as well. Because if I had 6 losing trades in a row, how do you think I feel as a trader to be able to place the 7th trade? If I don't know my numbers, if I don't know that probability and the distribution of win-loss trades within that realm of probabilities, then I might feel that I don't have it, I can't emotionally be able to put the next trade on. But if I know that this is all about probabilities, and I know that there's a very high likelihood that the next 14 are going to be winning trades, I have no issues going and putting on the 7th trade. So keeping a log, being aware of where you sit within your trading capabilities and where are your win-loss ratios and all that is extremely important. Okay, so as we said, we don't need a stop loss. We have built-in protection for our trades, and you can, this is one of the most fantastic thing. Even the market, if it's not moving, you can still look to profit from the market. And sometimes you'll find, you know, in days such as before non-farm payroll, right? And you're looking at the future markets, because non-farm payroll comes an hour before the market opens. During that day, during that Friday, you'll find that the market is hardly moving, and you think, oh, I can't find any opportunities today. But actually, if you're looking to utilize Nadex contract, you don't need the market to move a lot in order to make a 1-to-1 out of that one. So it's a really nice scenario that you also have another vehicle to profit in a market that really going sideways. And you'll see also the candles are very small. There's not much volatility. There will be after the reading comes out, but before those really big news, you'll see that the market is going quite flat. So you're looking at expiry that before those news are due to come out, and it's quite a nice another element to add, another as a weapon in your arsenal of trading, really, to add to that, because you won't be able to do that in a traditional sense. Traditional sense, you just go, yep, it's non-farm payroll today, I got nothing to do until the end, until the announcements come. But I would look for something as an expiry before the announcement and look to trade it as well, or even close that position before the time comes in. And it really is a very nice opportunity to have. Now, I want to tell you a bit more about the advanced course. So it's a 4.5 hours education package. We do that over 3 weeks, presented by one of us, the team at Trade with Precision. What we do, we teach you 2 complete trading strategies. So I mentioned a little bit about them. One of them is the trend flow, is where we are looking to identify in a downtrend the next lower high, and in an uptrend the next higher low. So looking to do that with high probability, so lots of elements to stack up one on top of the other to strengthen the reason to enter at that point. And the next one is a breakout strategy, so basically looking at levels of support and resistance and say what is the likelihood that this level is going to break and the market continue in the direction of the overall trend, or would the market reject this level and continue in the other direction, or is it still going to just kind of kiss that level for a little while before looking to decide what to do. So it is a very powerful trading strategy, and even if you say, okay, I'm not going to trade it as a breakout, knowing and being able to identify those levels and what is the likely scenario around that level gives you extra information about a trading opportunity, even if it's not a breakout strategy. So the elements of what we're teaching, even if you have your own trading strategy, you can use them to add more into your own trading strategy, because it's all technical ingredients. And think about it this way: if just one reason makes it slightly the odds in my favor, what would many reason will do? It will add, again, increase and increase and increase the probability of the opportunity going in my favor. So again, even if you have your trading strategy, then you can add more elements into your own. So this is value for over $900, but it's completely free for Nadex clients. On the first part, we're going to look at technical trading ingredients. The second part, we're going to look at the trading strategies themselves. And on the third part, we're going to take all of that information together, and we're going to look at many examples and how we can utilize the spreads and the binaries to trade those examples. And we're going to talk about, it wouldn't be just great opportunities, that's going to be a little bit boring. It's going to be a bit more of what we did today. We can't always say this is a perfect opportunity, because we don't live in a perfect world, and we want to see different stuff, and we want to know how to recognize the things that, are not always perfect. Will I take that trade? Will I take it differently? Will I do something different around that scenario? So a bit more out of real life example rather than everything's perfect. A question: will you try to give in evening for West Coast? I don't know what times the sessions are set to be. Let me see if I can find that out. I think it's going to be at the same times as this one. It's going to start on a Thursday, the 11th of, what is this one? 11th of February. And it's going to be starting at the same time as this one starts for you. So depending where you are in the US, it's going to be at the same time. I gather that it's not always an easy time for everybody, but it's an hour and a half, and it really is very, very worthwhile to join in. As I said, it's completely free for Nadex client, and you can email questions to customer service at nadex.com, or you can call Nadex as well. And to join, you can simply visit nadex.com and go for create account. If there's any specific questions about the platform itself and things that you're trying to do, or about your account in specific, then the best thing to do is to contact Nadex. How long did it take you to learn Nadex platform? Not very long, I gotta be honest. But I've been trading for a while, and I'm also, in my profession, I'm a IT engineer, so I feel quite free within computers. So not very long, probably within an hour So it's but it you know, I wouldn't compare. Everybody is very, very different. And you know what, you got great customer service, and this is one thing that I do. This is very much in my personality. If I don't understand something, I pick up the phone and I call and I nudge them until I know exactly what I asked. So I think and it helps, because you don't want to be seeing the best opportunity that you love so much and then you find out that you don't quite know how to place the trade. I would play on the demo as well. You get a demo account, play on it, see that you understand, and give them a call if there's any questions, or an email. I would do that. I did that. So it's really is important. Think about it. As when you're driving a car, you do want to know where how to shift gears if you have it on manual, or where the wheel is, and how to you know, to use the car, where the gas is and the accelerator and the brakes before you're entering into the car. So it's quite the same. You want to know how to operate the platform before you're looking for trades and entering into trades. So playing with the demo, very, very important, and you have access to the demo. And call them if there's anything that is unclear. Absolutely call them. Great customer service, so you'll get all the answers, I'm pretty sure. Where can we get the package? For this one, for Nadex, it's going to be online. As I said, the first session is going to be on the 11th of February, and it's going to be at the same time as this session was for you, depending where you are in the US. And it's completely free. Yeah, this one, the education one. Yes, it's going to be just the same. It's going to be live, and it's going to be via webinar. So you just join in. You go to if you have an account already with Nadex, then you can just join in for this education program. As I said, the first session is on the 11th of February, same time as this one started. Will you put? Oh, okay, Ken. I will. I can't answer this right now, so hopefully I can. Okay. I see what you're saying. Okay. I'll do my best. I'll do my best. Is that okay? You can maybe put it as attention to me, and maybe they'll forward it. Okay? You're very much welcome. Absolutely welcome. All right, guys, we have reached the end of our presentation today. If there's any questions, I'm very happy to stay and answer them. Otherwise, I look forward to see you on the next presentation. We're going to have one for the euro dollar, so a special one on euro dollar. And of course, on the advanced course, I would very much recommend it. As I said, even if you're trading, just a bit more information about technical analysis. It does help, and you know, even for someone who said to me, I'm getting in at the end of the trends, it will help you see a bit more about how to read the market and how to be not getting caught in when the market is running out of momentum and then take you out of your opportunity, or other reasons why the market might change direction at that point. So there's a lot of technical that when they come together, they would make sense to you, but you need to be aware of them, I reckon. And as with anything, guys, it takes time. It takes time to understand and to practice. Nothing replaces practice. Cool. So if I see there's no more questions, so thank you, everybody. Thank you for joining me. Okay. Can you give me any advice as a newbie to start trading? I would definitely attend the advanced course, and ask as many questions as you can when things are not clear. Yes, Nadex is a fantastic start. You get a lot of information on how to trade, and also I love binaries. I gotta tell you that the fact that you get a capped risk is one of my favorite scenarios, especially in this type of market. So I am completely hooked. I like binaries. So that will be it. And practice, I'll say practice. Nothing replaces practicing, and understand how to read the chart, how to read the price action, and play with the demo. I would not go into real live account trading, placing trades, until you understand the demo. And I wouldn't say, you know, spend 5 months of it, because that's not me, but understand what you're doing. That's definitely. And you can also start small as well. You don't have to start big. There is a difference you'll find, psychologically speaking, between going into a demo account and placing your own money. I can't advocate anything, don't get me wrong. This is just as a psychology explanation. We treat it differently. So what I did personally when I started with a cup of coffee. What I mean is that my risk was the value of a cup of coffee. So I could say, okay, I've lost another shot on my coffee, and now I can have a double shot, and I can have a triple shot in my coffee if I made a 3-to-1 out of a trade, something like that. So it will still have a meaning, it will still be real money, but it wouldn't hurt me as I'm starting, because there are mistakes and we all make mistakes. Okay, it just seems too good to be true. Trading is not, how should I say it? It's not hard, but it's not simple. Okay, it's just like with anything that comes in life. When you start something and you get excited about it, you don't see the dangers in it, and you don't see the mistakes. But as you go through it, you do mistakes, and then you overcome them, and then, you know, when you take responsibility for your action, you probably won't do the same mistakes again. You learn from your mistake. Trading is not about complicating reading the price action. Trading is very much a psychology. How do I stay disciplined in adverse condition? You know, how do I, if I see the market selling right now like there's no tomorrow, how do I not jump in? How do I still wait for a better trading opportunity? Discipline is very important. It might sound too good to be true. It's not a bad profession to have, otherwise I wouldn't be doing this, but it's not simple. I don't want you to think that, you know, from here onwards it's easy. It's not. It's not simple, but it's also not hard. There are some signals services out there. Do you have some kind of signals? No, I do discretionary trading. I don't subscribe to any signal service. I don't believe in them personally. I've tried auto trading. As I said, I'm an engineer, so first thing that I've tried was programming signals, and I found that there's nothing that replaces the discretionary trading. And there's lots of books out there to talk about our ability to make a decision that artificial intelligence is unable to do. And I do believe that we see things differently than what the computers, when they just calculate things. You'll find that, and this is where I say, because I believe market moves mostly by emotion. This is something that a computer cannot predict, but as a human mind, you'll find a way to see this without always being conscious about what you see. Let's put it this way. There's a very, very good book out there called Thinking Fast and Slow that talks about the way we think between the two systems in our brain around that. And I think the guy who wrote this won a Nobel Prize for economics. So it's very interesting. It relates pretty interestingly into trading as well. Here's a thought: when starting off, it depends on what type of lifestyle and like how much one eats. Like starting out trading would probably not be able to fit someone with a 44-inch waist. Amateur may need to maintain a 28-inch waist to survive. That's fantastic. Yes, when you start trading, you probably need to eat moderately. Or yes, bread and water for the start. But as you progress, you'll go into chocolate cakes and fondues and things like that. A question: binary or spread for beginners? They're both viable. I think that for beginner, just the idea of with spread, it's harder to find a better spread. Let's put it this way: the more expiry contracts or more strike prices in binary than in spreads. That's one thing. The second thing is that you'll find that with spreads, you're not always close to the ceiling or to the floor, so there might not be a good spread there. So there are usually more binary options than there are spread options available. So I would look probably first on binaries, but the spreads are quite as good as well. If I'm looking to buy and the spread sits on the floor, I'll take the spread. But it's all depend on what you're looking to do. There is a webinar that is dedicated, one for binaries and one for spreads, if you want to understand more about them. I think it would be useful. Okay, cool, fantastic. So thank you, everybody. We ran a little bit over time with the question, but that's okay. Thank you for joining me here today. Wish you a fantastic trading week, or the end of the week, really. Fantastic trading year. And I look forward to see you on the next webinar. Happy trading. Have a good weekend. Yeah, you too. And I'll speak to you soon. Bye for now.